Hey everyone, welcome to this explainer. Look, whether you've got a digital wallet full of crypto right now or you're just watching this wild market from the sidelines, today we are conducting a purely objective audit. We're going to stress test Bitcoin's foundational narratives against hard economic data, just to see what actually happens when you strip away the marketing and strictly look at the numbers. Okay, let's dive right into this. Here is the roadmap for our analysis of this trillion-dollar asset. The Jenga analogy, the Satoshi vision, the 3 strict rules of money, the real-world El Salvador test, and lastly, the greater fool theory. Starting things off with part 1, the crypto game of Jenga. So the source material throws out this absolutely fascinating analogy. It argues Bitcoin isn't just another crypto project, it's actually the foundational bottom block in a massive, highly unstable game of Jenga. You know, if that bottom block gets pulled out, the entire broader crypto ecosystem is coming down with it. But to really grasp its structural integrity, we have to look back at what that block was actually built to do. Back in the original 2008 white paper, Satoshi Nakamoto laid it out clearly. The vision was a peer-to-peer electronic cash system. Plain and simple, it was supposed to be digital money, a decentralized way to send cash directly to someone else without a bank getting in the middle. But what's really wild is just how far the current narrative has drifted away from that original vision. I mean, we constantly hear these pitches, right? Bitcoin is digital gold, or it's the ultimate inflation hedge, or it's the inevitable future of money. The analysis we're looking at points out a pretty distinct pattern, though. The public story seems to conveniently pivot every single time the underlying technology fails to deliver on its previous promise. So for this explainer, we're going to tune out the marketing noise, and we're just going to evaluate the hard data. Moving on to section 2, the 3 rules of money. If Bitcoin is genuinely going to be this revolutionary form of money, well, it has to pass 3 basic tests that economists use to define what money literally is. Step 1, it has to be a medium of exchange, meaning it's widely accepted for everyday payments. Step 2 is being a store of value. You can safely hold it today and know it'll buy the same amount of stuff tomorrow. And step 3 is acting as a unit of account, basically being a standard measure for pricing goods. To actually be considered true money, an asset doesn't just pass 1 or 2, it needs to check all 3 boxes. All right, section 3, why Bitcoin fails the test. Let's test that first requirement, the medium of exchange. To be a good medium of exchange, your system has to be fast and it has to be efficient. Right now, the Bitcoin network processes roughly 500,000 transactions a day. Now that might sound substantial until you put it up against a traditional network like Visa. Visa processes approximately 65,000 transactions every single second. Think about that. Visa's network could clear Bitcoin's entire daily transaction volume in under 8 seconds. Boom, done. The data here argues that this makes Bitcoin just way too slow and inefficient for global everyday use. And this brilliantly illustrates the next massive hurdle, energy efficiency. Check out this staggering number, 43 days. That represents the equivalent electricity consumed by just one single Bitcoin transaction. We're talking about one transaction using the exact same power that an average American household uses to run their lights, their appliances, literally everything, for a month and a half. To put that into perspective, one single Bitcoin transaction has a carbon footprint equal to roughly 1.5 million Visa transactions. The source makes the case that this incredible friction is exactly why it hasn't become a widely adopted payment system. It's just not practical. Okay, so what about test number 2, store of value? Now, advocates usually point to its fixed supply here, arguing it operates kind of like gold. But listen, a true store of value requires stability to actually preserve your purchasing power. And Bitcoin? It's notoriously volatile. It frequently swings 20% in a single month. But honestly, even more critical than that is the ownership distribution. Despite this heavily promoted narrative of decentralization, roughly 2% of addresses control 95% of the entire Bitcoin supply. When wealth is concentrated that heavily at the top, the analysis notes that price movements can be incredibly easily manipulated by a tiny group of whales, and that completely undermines its reliability as a safe store of value for regular folks. Finally, we hit the third and final test, unit of account. Does Bitcoin function as a standard economic measurement? The data says no. Because even among the businesses that actually do accept Bitcoin, they aren't pricing their goods in Bitcoin. They price that cup of coffee or that pair of shoes in US dollars, and then they simply convert that exact dollar amount into Bitcoin at the exact second of checkout. So in this scenario, Bitcoin isn't actually measuring economic value at all. It's really just a temporary pass-through vehicle. It fails the unit of account test entirely. Let's move to section 4 and see how this builds, the El Salvador test.
Now, a super common defense you'll hear is that, hey, Bitcoin just hasn't been given a fair shot yet. But the source material points out that we actually already ran a massive countrywide experiment. Back in 2021, El Salvador became the first country in the world to adopt Bitcoin as legal tender. And the government went all in. They launched a national digital app, they legally required businesses to accept it, and they even handed every single citizen a $30 free Bitcoin bribe just to try the thing out. This was literally the perfect real-world opportunity for Bitcoin to prove its utility.
So how did this grand experiment pan out? Well, data sourced from the IMF and the National Bureau of Economic Research paints a pretty stark picture. Despite all those heavy government incentives, 60% of users downloaded the wallet, cashed out their free $30, and literally never made another transaction on the app. On top of that, cross-border remittances, which remember were supposed to be Bitcoin's magical, frictionless killer use case, they saw massive rejection. Less than 2% of remittances in El Salvador actually use Bitcoin today. Currently, 66% of the population considers the project a complete failure, and 77% outright oppose using any more public funds to support it. When given the absolute prime option, the public fundamentally rejected it as everyday money. All right, which brings us to Section 5, the greater fool theory. So this begs the ultimate question. If Bitcoin fails as a medium of exchange, a store of value, and a unit of account, where is its trillion-dollar valuation actually coming from? The source analysis argues that once you strip away all the slick marketing, the valuation relies on a very old concept in behavioral finance called the greater fool theory. This theory states that the price of an asset doesn't actually need to be justified by its underlying intrinsic value or utility. It's justified simply by the prevailing belief that a greater fool is going to come along later and buy it from you at a higher price. Unlike a stock that pays out dividends or a piece of real estate that generates rent, Bitcoin has no widespread utility or cash flow. It relies 100% on this psychological cycle of belief.
So the crucial point is how this exact cycle is maintained. It always starts by crafting a compelling narrative, something like digital gold or the new future of money. You use that shiny new narrative to attract fresh buyers into the market, and their sudden demand pushes the price higher. That rising price, well, that acts as its own marketing to attract even more buyers, and the cycle just repeats again and again. According to the source we're auditing today, these crypto narratives are meticulously crafted for one sole purpose: to continually feed the machine with new money. Because the very second that new buyers stop entering the market, that foundation of the Jenga tower collapses.
Which leaves us staring at a pretty uncomfortable reality about this specific financial ecosystem. If the system is built not on utility and not on solid economics, but almost entirely on the continual recruitment of the next buyer, we have to ask a genuinely provocative question. When will the market run out of greater fools? Thank you so much for joining me for this explainer. Keep analyzing the data, always keep questioning the narratives, and I'll catch you next time.